Right, so welcome everyone and thank you for joining this session on new advances in relational event models at this fourth edition of the IDWSDS conference. As you may know, the theme of this year's conference is Thriving in Your Environment. So this session is recorded and all the recordings will be available on the YouTube channel of the Caucus for Statistics, Women in Statistics and Data Science. So today we will have 3 talks, and in between each talk we will have time for 1 or 2 questions. So I will please request that you ask the questions on the chat, and I will read them to the speakers. So without further ado, I am very pleased to introduce our first speaker, Martina Boschi, who is a third-year PhD student at Università della Svizzera Italiana, and today she will talk about her recent work on graph sampling methods for REMs. So I will now stop sharing and let you share your screen.
Can you see my screen correctly? Thanks.
Yes.
So, hi everyone. I'm Martina. This work that I'm presenting today is a joint work with my research advisor, Ernst Witt, and my host advisor, Eric Kolasik at McGill University during my visiting period there. So, in this session, we are going to speak a lot about relational event models. Relational event models are statistical models that we employ in order to explain the dynamics underlying event occurrences. And usually what we do is to explain events as the result of some endogenous mechanisms. However, endogenous covariates are very costly to compute. And so my idea would be to employ graph sampling methods that today are used to describe temporal networks as a modeling tool in order to speed up the covariate computation. And this would allow also relational event models to access huge event sequences that today are prohibitive due to the computational cost of the covariate. If you're not familiar with the relational event models, I will introduce briefly an example in order to understand what we deal with and what is my research goal. So when you fit a relational event model, your statistical units are the events. So you have triples in which you have a time, a sender that is interacting with a receiver. In this simple system, we only have 3 actors, that is me, Martina, Deborah, and Federica. Now, let's say that we want to explain these events as the result of a reciprocation. So we want to understand the tendency to reciprocate messages sent in a chat. And so for each time point, we have to compute this value that depends on the previous history of events. Now, let's say that we do that for the last event. The last event in this case is a message from Deborah to Federica, and we want to understand how many messages Federica did send to Deborah before. This number is equal to 2. This was easy. But in general, we may deal with way larger event sequences and particularly with structures that are not only dyadic as a reciprocity. Indeed, for example, in this system, there is also me. So it would be interesting to understand triadic structures that are guiding this event occurrence. The idea of this project is to not rely on the entire history, but on sampling this event history and consider only a portion of it. And so we would compute the covariate on the sampled history. So if we look at the sampled history, now the number of reciprocal event is equal to 1. Of course, we need to correct for the fact that the sampled event history is always smaller than the original event history. So we need to apply this correction for 1 over the proportion of the history that we consider. But this is not enough. Indeed, what we are doing is to replace the covariate, that is something that in a regression is fixed, with something that is instead is random, is an estimator. So what we do is to rely on error invariable regression. So if you're not familiar with that, I included a small example concerning linear regression, in which basically the idea is that you cannot access the true covariate, you only access a wrong quote-unquote quantity that can be expressed as the true covariate plus a measurement error. The idea is that if you fit directly the naive model using the version of the covariate that you can access, the coefficient that you obtain is biased. However, there is a asymptotic theory showing the convergence of this coefficient, and this can be expressed as a function of the true one and the variance of the measurement error. This means that if you know the variance of the measurement error, you can recover the coefficient that you are interested in. So this is what we want to do. We want to express our estimator as the true covariate, a covariate plus measurement error, but we have to access the variance of the covariate estimator in order to apply this method. So now I need some more formal details on the model in order to introduce the research goal. And for this reason, I briefly say something about relational event models that hopefully useful also for the later sessions. So the idea is that we have a set of dyads and that can interact, and for each couple of actors, we count how many interactions did occur until a certain time. We are interested in modeling the intensity of this process that is predictable, and we can say something about the instantaneous rate of occurrence of this dyad interacting at time t. We can decompose this rate into 3 blocks. So first of all, if we want to understand the rate of occurrence of an event, first of all, we need to say, is it at risk of occurrence? And then we need to define what are the baseline conditions of risk. And then we can try to include in our model some features that are specific for that dyad at time t. And this is where the covariates that I was speaking about at the beginning, for example, reciprocity enters into play. Estimation is usually performed via maximum likelihood, so we compute the probability of our event sequence as the joint product of the probability of events that is expressed as a ratio between the rate of occurrence of an event and the sum of the rates of all events competing at that time. We use a sampled version of this risk set that only contain a limited amount of non-events, so events that are potential at that time, in the denominator of this formula. This sampling, I would like to underline that this sampling is not related to my research goal. This is already something that in the relational event modeling literature is already applied. However, I want to underline that if you just sample 2 events, so one event and the event that indeed occurred, you can express this likelihood as the likelihood of a degenerate logistic regression. So you deal with the likelihood of a logistic where the response is fixed equal to 1, and the covariate are the difference between the covariate of the event and the covariate of the non-event. Why do I need to introduce this now? Because this has 2 important implications for my work. First of all, if I employ this logistic, my regressor become the difference of covariate. So it's not enough to estimate the value of the covariate for the event, as I did in the example that we saw before, but I also need to do the same for the non-event. and I need an estimator for the difference. I have two sources of randomness and I need to account for that. Also, since I deal with a logistic, I can exploit the literature that has been developed for logistic regression that is way more easy than what you would have for event history models. Now that we have the modeling and the inference tool, we can define our general formulation for a covariate. As I said, reciprocity was an example, but can be seen as the sum over the previous history of events of quantities that you can check. So you can check, for example, if the previous event satisfies a condition, for example, being the reciprocal of the event of interest or the non-event of interest. When it comes to estimating this quantity, you need to apply the bias correcting factor and then an indicator variable that is reporting if the previous edge is in the history or is not. Under a sampling scheme that considers the indicator to be independent and identically distributed Bernoulli random variable with the probability P, we have, first of all, that the sample size of our sample history is not fixed. We define the average as a small n, and that we can quantify the expectation and the variance of our estimator. First of all, we see that the estimator is unbiased, and also we are able to quantify its variation. And this was exactly what we were looking for. Indeed, we can now write down our estimator as the true covariate plus measurement error, and we know the variance of this measurement error. And so we can apply the correction that has been developed in the logistic regression framework in order to indeed correct the naive estimator for the coefficient. And these are all quantities that either depend on observed data or on the naive model, so quantity that you can, quote unquote, easily obtain. This is called a regression calibration, and the idea is that for increasing sample size, you are able to recover indeed the result that you would obtain if you use the complete history. However, regression calibration works well only if the measurement error is quite small. So this is why we also explored another technique called simulation extrapolation that is based on the same idea. So we know the relation between the true estimate, the naive estimate, and the variance of the measurement error, and we generate several copies of the estimate depending on an increasing amount of noise, and then we recover the result that would be if there were no measurement error. This is very nice because in some formulation also allows, by means of bootstrap, to obtain this result without the exact knowledge of the measurement error variance. And we see here that at the price of a larger variance, we are able to find unbiased estimate also for a very small proportion of the event history. I don't have the time today to explain the extension to the transitive closure. I just want to mention that we did what I did for the dyadic covariate also for transitive structures. So when we have more than two actors involved, and this is where the computational cut is really relevant. If you are interested, you can just contact me later or write in the chat. So today what I did was to present how to sample relational events, how to sample relational event history, how to estimate some covariate that are unbiased and with non-measurement error variance that we can then employ in order to find unbiased estimate for our relational event model with measurement error. Thank you.
Thank you very much, Martina, for the excellent talk. So we're a bit out of time, but there is one question in the chat that maybe you can ask quickly. The question is, what is the type of speed up that you get with your method in typical relational event data with, say, 100,000 of events with a triadic effect? Is it a factor of 10, 100, or even more?
I lost at the beginning, so is the computational cut you asked?
What is the
What is the
speed up?
computation?
Yeah,
okay, yes, okay.
Yeah.
So the idea is that according to the transitive closure, for example, I would need to do n, so for each previous events, and this is the order of the number of events that I need to go on. So, for example, if I have, how many did you say? 100,000 events?
100,000 events. Yeah.
This would be basically the squared. Instead, basically, if I sample, I report this quantity to the sample size squared. So it depends, of course, on what is the sample size, but the reduction is of that type. Yeah. Thank you.
Thank you very much, Martina. So we'll quickly move on to our second speaker, Federica Bianchi. Federica is a postdoctoral researcher at the University of Cambridge and Università della Svizzera Italiana. And today she's going to present her recent work on ERMs with polymorphic network times.
Okay, thank you, Deborah. The paper I will be presenting today is a joint work with Martina, Alessandro Lomi, and Ernst Witt. The motivation behind this work lies in a long-standing stream of my research based on network mechanisms, and especially the evolution of network mechanisms in evolving relational systems like markets and organizations. So the idea is that in the field of relational event models, those network mechanisms have an inherent temporal component because they emerge from sequences of time-ordered events. But the thing is that most specifications of relational events models, unfortunately, still assume that network mechanisms operate at the same time scale and at a constant velocity. So this work challenged this assumption, and and the research question we ask ourselves is how we can model and test for the presence of what we call polymorphic network times. Thanks to the introduction of Martina, I can slightly speed up on these technicalities. To do that, we rely on the apparatus provided by generalized additive models to keep track of these temporal components of network mechanisms. And how we do that? Okay, we estimate smooth nonlinear functions, event rate functions, to capture these dynamics of network mechanisms through time on sequences of relational event, and in particular, we used in regression splines to capture this nonlinearity of network mechanisms. So this is our model. We model a relational event model through an event rate functions of the number of events occurring between a dyad composed of a sender and a receiver. And our model formulation is composed of three main components. The first is just an indicator function, YSR, telling us what dyads are at risk at a specific point in time t. Then we have this lambda 0t, which is considered as a baseline rate function. And then we have these other components, f, which is the contribution function of covariance to the log rate, which is exactly modeled by an additive nonlinear fixed effect model with linear random effects model, and this is the core component of our model. So this lambda 0 t component, the baseline rate, capture the residual effects that are not explained by the network covariates, and more in general can be associated with global covariates or to anything that is not related to sender and receivers. And then we have exactly this Fj, which is the smooth nonlinear effect of the J network statistics. Gamma is just a vector of random effects that we added to our model specification to take into account, for instance, sender and receiver characteristics. Okay, the inference schema is very similar to that Martina presented before. So we estimate maximum partial likelihood, and the partial likelihood is given by the multinomial probability of observing the actual interacting dyad among those that are at risk at that time, of course, conditionally on the history of past event. This is the function to be maximized, and this is exactly the function that Martina also presented before. And in this case, to avoid overfitting, this function to be maximized is associated with a penalty term, which basically shrinks to 0 the effect of network mechanisms that are not statistically significant. And why we do that? Because we said every mechanism of interest can have this polymorphic, and we will see in a bit what I mean, internal clocks. And the idea is that not all of these internal clocks are equally important, so contribute to equally to the log rate. So our to keep track, of these internal clock of network mechanisms, our network statistics are defined in terms of inter-arrival time since the last relevant event. As Martina did before, we can take reciprocity, a direct type of reciprocity involving a pair of sender and receiver as an example. So for the reciprocity, network statistics is just represented here. So I observe a reciprocal relational event when at time t I observe a relational event channeling resources from S to R after a relational event in the opposite direction, so from R to S, occurred before. So for a given mechanism, which we call J, the network statistics is defined, you see here, as an inter-arrival time, which is weighted by a so-called scaling factor that allow us to specify these internal clocks that give rise to polymorphic network times. So this CJ is not a scaling, is not a decay parameter, is instead a scaling factor, and it can provide us information about the time windows or the time scale across which a mechanisms operate. For instance, this can be defined in terms of hours and days, and this is actually what we do in our empirical specification. We situate our study in the field of financial markets, which I've been extensively analyzed. And in particular, we focus on the European interbank market, which is a secondary market where European banks and in general financial institutions channel liquidity one to the other for many reasons. First, to fulfill some their liquidity needs, and secondly, they also have to satisfy certain reserve requirements that are imposed, for instance, from the European central banks and other regulators. We consider the stream of high-frequency transactions that occurred on the electronic market for interbank deposit, which is a regulated segment of this market, so namely a segment where transactions have been properly recorded. Those transactions are high frequency, and in the period we analyze, which is a period of market stability, those transactions are very high frequency. So basically, every few seconds, we observe a transactions. The period we consider is ranging from January 2004 up to September 2008, right before the Lehman Brothers crash. The resulting event data set is composed of more than 400,000 events. And we have 280 banks. Because on the high granularity of this setting, this is the financial markets, and in particular this market, are almost an ideal setting to study the temporal evolution of these mechanisms, and especially their internal clocks. In our model specification, we consider 4 different mechanisms, namely repetition, reciprocity, in both its directed and generalized form that we operationalized through cyclic closure, and we also include the transitive closure. We consider 4 different polymorphic network times defined on the basis of hours, days, months, and quarters. And those time frames have been proven to be meaningful time frames for letting the social structure of these mechanisms emerge, especially longer time frames like quarters. And as I said before, we also controls for global time covariates, like the time of the day and the day of the week, because the idea is that the trading on financial markets, and this is not an exception, is influenced by the exact time of the day. So trading at the beginning of the day has not the same intensity, for instance, as the trading at the end of the day, and the same for the day of the week. Imagine, for instance, on Friday, banks and credit institutions tend to close all of their positions. And also, we include node level random effects in this specific case to account for the propensity of European credit institutions to lend or borrow money. This is how our results look like. So for this is always the illustrative case of reciprocity, and we will see that here we measure the contribution of reciprocity along the 4 different temporal scales we defined. And what we immediately notice is that reciprocity is active at hours, exert its effect at the hourly and the quarter level, because you see here in at the daily and at the month level, reciprocity, the effect of reciprocity is not significant. And what does these pictures tell us? So first, if we rely on the contribution of reciprocity at the hour level, we will see that reciprocity vanishes very quickly. So it's very high at the beginning of the trading day, and it mostly vanishes at the end of the trading day. So approximately every 8 hours. And plus, if we rely on the contribution of reciprocity at the quarter level, we notice also that the contribution of reciprocity is as this oscillating form, which is not only nonlinear, but also non-monotonic. And this is a special feature that this modeling approach can allow us to capture. If we rely on what we find on the x-axis, so if we take the exp of changes over a time interval, let's say between time 2 and time 1, so the exp of this delta t represent the hazard ratio of the event that occur at t2 with respect to the event that occurred at t1 while leaving either factor constant. And so, for instance,
apologies for interrupting you, Federica.
Yeah.
We are almost out of time. Could you conclude within a minute, please?
Yes, I am. I think I can do that. So yeah, just briefly, the thing is a nice aspect of our results is that they can also be interpreted in terms of hazard rate. And in contrast to traditional relational event model, we will see that instead of point estimates associated to the mechanism of interest, we have this we have functions telling us how the effects evolve over time and across which and the temporal time scale across which it evolves. Here, briefly, we can also measure the contribution of these mechanisms and their time scale to the log likelihood. So saying how much each mechanism is important in the evolution of the system. Here we see that reciprocity is quite a prominent mechanism along with repetition. Also, extra-dyadic mechanisms operate, but their contribution to the likelihood is much smaller. So, in this sketch of our results, we add evidence of the existence of polymorphic network times. We also confirmed something we already know, so that the market structure is evolving over time, and it's not dominated by a single static logic, and an evidence for that is that these network mechanisms have different functional forms. And then we also notice something that is context specific and somehow counterintuitive, at least with respect to the literature on network mechanisms, is that the dyadic network mechanisms typically work on longer temporal horizons than their corresponding triadic network effects.
Thank you very much.
Thank you,
Federica. Sorry for interrupting, because the session is used for the later. I mean, the Zoom room is used for later sessions, so we need to move on to the next talk. But thank you very much for the very thought-provoking presentation. So our last and third speaker is Viviana Amati. Viviana is an associate professor at the University of Milano Bicocca. And Viviana, the floor is yours, and I give you a challenge to finish within 11 minutes, if possible.
Okay, thank you. For organizing this section, I present you his work on the use of random coefficients in relational event models. First of all, let me talk about a bit the context. Martina and Federica already introduced you. We are looking at a brief interaction between entities that are called relational events, which we usually encode as a triplet, where we have a sender, a receiver, and the time at which this interaction takes place. The aim of the analysis is that we want to explain the occurrence of relational events based on monadic or dyadic characteristics of the entities, like their gender, their age, or the living distance between them, previous event, if we think about phone calls as a relational event, whether a person called the other person before, and then contextual factors, the settings in which these actors are embedded. And formally, we model this process as a mark point process, which means that we have a point process where the point is the time at which a sender has the opportunity to initiate an event. And then we have the receiver of the event that is formalized as the mark of this point process. And we know that there is a correspondence between mark point process and Poisson count process. So to this mark point process, we can associate a count process. And this count process is modeled by this conditional intensity function. And depending how we define this conditional intensity function, we end up in different models. Here I will focus on models with separable conditional intensity function and that are based on this actor-oriented perspective, where we assume that when ties are created or interactions are created, there is a sender who initiates the event and then a receiver. So according to the Dubbe-Meyer decomposition that Martina already showed you, we can factorize our conditional intensity function into 3 blocks. One that models the rate at which actors get the opportunity to initiate an event, which is denoted here by this lambda SCT. And this is the component of the model that it's called the ground intensity function. Usually we model this ground intensity function drawing on the literature on survival model, and we can, for instance, use a Cox regression model, where we have lambda 0t, which is the baseline rate, the rate at which actors initiate events. And then we have a second part in the model that contains our explanatory variable, which explain why actors have different tendency to initiate an event. Then there is a second component that is the receiver component that, given the fact that actor S is going to start an event, we model the probability that is actor R that is going to receive that event. And this is modeled by a conditional multinomial regression model in which everything depends on this function f that again is a linear combination of parameter and statistics. Those statistics explain the occurrence of ties based on endogenous mechanism, right, reciprocity and transitivity, or exogenous mechanism, depending, for instance, on the actor characteristics. And what we usually do is that we estimate the parameter alpha and beta, which form the vector theta, in order to make inference of these processes, as Martina already well introduced. Now, when we look at relational events model in their original formulation, everything was assumed is that all these parameters are constant across time and also across actors. And a few years ago, a debate started about how to relax this assumption. And therefore, random effects started to be included in the models to control for 2 types of heterogeneity. One is entity heterogeneity. I told you that actors might have different propensity to create or to choose different receiver. Well, there might be an observed factor that might explain this different tendency, and therefore there are approaches. A previous work, a joint work with Alvaro Zeta, who was the first author and the later. And there is also an application for Martina where we talk about entity heterogeneity. The other type of heterogeneity that I'm going to treat today is contextual heterogeneity, which emerges when we observe different sequence of relational events on groups, for instance. So we pose ourselves in the context where we have a certain type of relational events, for instance, phone calls or email exchange, that are actually observed on the very distinct groups of actors, so that we can consider these sequences of relational events that are mutually independent. And what we assume here, for instance, we have a time, a sender and receiver, which is the way we encode a relational event, and we repeat this observation over capital G groups. Then we can conceive every single observation coming from as the outcome of a population of relational event sequences according to the paradigm that is defined as the multi-level network analysis. What we want to do now is to use this multiple repetition of sequences of events in order to make inference of the mechanism that might have generated it. Following approaches in statistics and adapted to the context of relational event models, we can use the meta-analytical approach, where we assume that these sequences come from a population and therefore the parameters of the models are random sample from a population. And what we can do then in a meta-analytical approach is that we analyze each group separately so that we get capital G different parameter vectors. And then we can combine the results based on the following model. We assume that the estimated parameters come from the population of the parameter plus the deviation that we observe from the population parameters. And the estimates can be obtained through the common edge estimator proposed by Cochrane. The approach that I'm going to quickly introduce today is a model based on random coefficients. And if we want to model the different propensity of vectors to create ties based on the group in which they belong, then we can use the shared frailty model for the ground intensity function. Here what we do is that we include a frailty. A frailty is just a latent factor that we include in the ground intensity function that allow us to control for differences in groups. And this frailty in the simplest specification can be added here by including an intercept term. So we define this frailty as the exponential of this parameter alpha. Conditionally on the frailty, then the relational events sequences are independent, and we can estimate the different factors using the EM algorithm. Now, if we want to control for differences also in the receiver choice, we can extend the multinomial logit model for the mark distribution by including this random coefficient part that is modeled using a multinomial distribution. Again, this is a natural extension of previous work that was done with PhD students at ETH, Alvaro Uzzaeta. Now, the estimation of this part is conducted by the Hamiltonian Monte Carlo methods. To conclude and to highlight the benefit of using hierarchical linear models compared to what has been done with the meta-analysis and the statistical approach, then I will quickly present a simulation study in which we consider 20 groups and then we generate a sequence of events of different length ranging from 10 to 1000. We've estimated or generated on a set of 40 actors with a model with a very basic specification. Then we estimate the relational event model over all the groups. We compute the pool estimate using the meta-analysis, and then we compute the estimates using the random coefficient model. We compare then the estimation through the baseline estimate that we would obtain using just a simple average of the single estimation on the sequences. And to compare the results, we use the mean square error, and we compare the estimate from the random coefficient model and a very simple average of the estimates for each group, and then the random coefficient model and the meta-analysis through differences mean square error. So briefly, here are the results. On the x-axis, you see the number of events. On the y-axis, the average difference of the MSE. On the panel on the left, you see the comparison between the random coefficient and the individual estimates. What we observe is that, well, the difference in the MSE and the mean square error decrease with the number of events, but in general that this variance is also quite large, and we have a small number of events, meaning that the hierarchical estimates are usually less noisy than the individual fits. And similarly, when we compare the random coefficient and the meta-analysis. Here, the difference between the mean square error is reduced already when we use meta-analysis compared to the individual estimate, but this noise remains. So to conclude, what we have shown is that, well, we can extend the relational event model by including random coefficient. And the estimation can profit from methods that are already implemented in the R package and known in the context of random coefficient model. The evaluation of the model shows that, well, the random coefficients are usually less noisy than any other approach. And with this, I conclude my presentation, hopefully in time.
Thank you very, very much, Viviana. You're perfectly on time. And unfortunately, we don't have time for the question which is on the chat, but I invite you to maybe answer offline. And also, I invite everyone also to continue the discussion offline. So this is the end of the session. I want to thank the speakers, all the 3 speakers again, and also wish you a very nice rest of the conference.